Sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, growing tensions here at home and overseas are having a major impact on the geopolitical landscape. Eurasia Group President Ian Bremmer will share his insights. And later, the new rules of real estate taking effect this summer will break down what home buyers and sellers need to know ahead of the change. But we begin with our expert panel and 3 things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Elizabeth O'Brien, and Jacob Sonnenschein. So, Ben, it was shaping up to be a pretty ugly week on Wall Street, and then in the last, hour or so of trading, instead of going to the Hamptons and the beach, traders put in a bid, and the markets ended up on the day, at least Friday.
Well, we're assuming it was real people, but you're absolutely right. It was a terrible week. It was looking like an awful week, a really bad end to the month. But instead, we got this massive rally on Friday, and it could have been programmatic trading, buying the dip. It could have been real people, but something came in to take advantage of a bunch of these stocks getting knocked down. And so it was still a down week for the market, but it wasn't nearly as bad as it could have been.
So the algorithms did not want to go to the beach.
Sounds that way.
Okay. So what were the forces pushing the market down during the week? Why were traders unhappy?
No, I feel like it had to do more with sentiment than anything else. There wasn't any real news that would have shaken things up one way or the other. Instead, I think people just came into the week very optimistic. Jacob actually wrote a column this week talking about that there was a disconnect between how much the market has actually gained and how optimistic people were, and that needed to get worked out a bit. And I think we'll see next week if enough of that got worked out with this kind of pullback and then this rally on Friday for the rally to continue.
We'll also be looking at jobs numbers next week. Obviously, everyone's watching that for inflationary hints. What else do you think will be on traders' minds in the coming days?
Well, I think a lot of it is going to come down to that jobs report. They're going to want to see that the economy is still strong enough that it keeps going. We've had a lot of negative economic surprises recently, and that isn't good if it keeps going on for too long. So it has to be strong, but not too strong where we start worrying about, is not only the Fed not going to cut rates, but is it going to have to raise rates as well? And that would be a real problem. For now, that seems to not be the case, and maybe the market can start rallying again.
Alrighty, Jacob, that AI rally that Ben's talking about has been what's powering the market so far this year. But now it's not enough to be just an AI play. You have to deliver.
No, it's not enough because, like you said, the market is up a lot. Salesforce was one of those stocks that was up a lot from its low into earnings. And now you get to earnings. Salesforce posted 11% revenue growth for the quarter. And then for guidance, they said, well, going forward this year, we expect 8 to 9% growth. They talked about customers delaying spending on projects, and it's a macro issue, and their customers are watching their budgets. Well, the problem is Wall Street's going, is your AI offering really as competitive as it needs to be? Is that really the issue? Salesforce gets knocked down. Doesn't matter what the issue is, because stocks are priced for a lot of growth. You have to deliver. You have a company like C3 AI that's a really small company. They had revenue of 86 million, but they beat by 2 million, and the market was like, great, the growth is going to be what we thought it was going to be, and that stock was roaring. So now you got to deliver.
HPQ also delivered on AI.
Absolutely. They're a beneficiary, not quite like the other two I mentioned, but total beneficiary, beat and a good move up in the stock.
You know what's been interesting is this phenomenon, this winner-take-all kind of thing has been visible in retail as well. Big winners, big losers.
Oh, man, it's so hard in retail. Retail's all about hand-to-hand combat. So you had Foot Locker, which only has to focus on footwear and is trying to kind of revamp its business. It's been a tough business. Actually, it kind of looks like with the guidance, sales could be up 1 or 2% at some point later this year because they're selling Nike, Hoka, and On. They know what to focus on. Kohl's revenue is down year over year. It's a huge department store. They even said apparel, which is most of the business, they didn't know what to focus on.
My favorite stock in that sector was Abercrombie & Fitch, up 444% in a year, crushing NVIDIA. Who would have thought? Elizabeth, let's talk about this Goldman Sachs asset management report that you've been focused on, showing targets for how much you need to save in retirement. Nobody's hitting it, or most people aren't hitting the number, but at the same time, it wasn't all pessimistic.
That's right. There's some good news. Gen Z is off to a good start investing for retirement. They've got a median of 29,000 in their retirement accounts, so that's good. Now, part of that is they're benefiting from relatively new features like auto enrollment, which has really grown over the past 15 years. Sort of you get automatically plunked into the 401k and you have to opt out. And the report also looked at some competing pressures that people are facing.
taking care of your parents, paying for college, et cetera. So the millennials are kind of getting hit with those costs that haven't hit Gen Z yet.
Yeah, the millennials are getting slammed, and it's probably going to be Gen Z's turn next.
Artie, of course, you have not quite a silver bullet, but a bit of a solution, a little way to help in retirement. You wrote a column about the Roth 401k, which has always been good, and it just got better.
Just got better, because starting this year, there are no required minimum distribution requirements for your Roth 401k. That means you can let that money compound, continue to grow throughout retirement, assuming you have other funds to live on, and then you can give your heirs a big, fat, tax-free inheritance.
And people get all torn up as to whether it should be the Roth or the traditional approach.
Right.
But look, if you do the Roth, you're going to put the same amount of money in, essentially paying your taxes now, and then 40 or 50 years later, if you're 28, you're going to have tax-free money.
Exactly. You do have to pay your taxes on your contributions, but you get tax-free withdrawals in retirement, and everybody says it's likely tax rates are probably not coming down from here. They're just going to go up.
Good advice. Thanks, Elizabeth.
Thank you.
War raging in the Middle East and Europe. Meanwhile, the U.S. election here at home is heating up after the unprecedented conviction of former President Trump. Eurasia Group President Ian Bremmer will break down the changing geopolitical landscape and what it all means next. The ongoing war in Ukraine, the conflict in the Middle East, and an historic guilty verdict for former President Donald Trump ahead of the 2024 presidential election are all having a major impact on the geopolitical landscape. Joining me now is Eurasia Group and G0 Media President Ian Bremmer. Ian, good to see you. Thanks for coming on the show.
My pleasure.
So the Biden administration, for the first time, said it will allow Ukrainian forces to use American-supplied weapons for limited targeting inside Russia. Is that going to have a meaningful impact on Ukraine's defenses? And what do you think the risk is of escalation? What could Russia do in response?
It should in Kharkiv, which is the second largest city in Ukraine, millions of people, and the Russians are increasingly, their front lines are encroaching on it. They're able to hit it. So that does matter. But of course, every time we see an escalation from the United States or the West that they wouldn't consider a few months ago, number one, it shows a level of increasing concern, anxiety that the Ukrainians aren't doing so well in this war. The Russians are doing better. And also, it raises the specter of potential escalation. I don't think the Russians are about to roll troops into a NATO country, but the likelihood that you might see asymmetrical attacks. So, for example, more cyber attacks against the West that were considered red lines back before the invasion of Ukraine in 2022, that likelihood, I think, is going up.
All right, I would follow up there, but let's go 2,000 miles due south of Kharkiv, I believe, Gaza. Do you see any path to a ceasefire, to the release of the hostages?
Near term, the fact that the sides are still talking and that Israel continues to move incrementally in what they are willing to consider for a short term, a temporary ceasefire, I think that's productive. Now, I mean, will Hamas actually agree to a deal? It's very hard to even talk to Hamas. The leadership, you get a message to them, and it's another week or two before you can get a message back, and things change frequently in the interim. As you know, there are Israeli tanks that are right now in central Rafah. There are a lot of civilians that continue to get killed. And by the way, a lot of Hamas fighters that have already gotten out of Rafah and are back in other parts of Gaza. So, I mean, I think that we're a little more hopeful that we might get a short-term ceasefire than we were a week ago. But we're not hopeful that this war is coming to a close anytime soon. No.
Yeah, I'm sure. In Sudan, there is a war raging that, frankly, most of the globe is probably not aware of. What's the most important thing for Americans to understand about that conflict?
Well, about 10 million Sudanese that are facing, serious humanitarian challenges, potential starvation, and need to forcibly migrate. It's not a threat directly to Europe or the United States, and there are almost no journalists on the ground. So in that regard, almost no one pays attention. I appreciate you asking about it. At G0, we've been trying to get more people to pay attention because from a purely humanitarian situation, this conflict is affecting more direct stress on the ground in the country than either in Ukraine or what we're seeing presently in Gaza or in Haiti, much closer to our shores in the United States.
Sure. Well, a bit more attention was paid, just a little bit more, to a courtroom in New York City on Thursday. A guilty verdict that will not change the minds of Donald Trump supporters or his detractors. But at the swing voter level, there could be some impact. Take us there, and what do you think the most important issues will be for swing voters? Is that one of them?
It is an issue. They say that it's not one of the most important issues. They say that they have bigger priorities, both those that lean Biden, abortion, and those that lean Trump, inflation and the border. But it's not irrelevant. Of course, it's the first time that a U.S. president has ever been convicted of anything, and these are 34 felonies. Of course, at the same time, it's also the least consequential of the cases that Trump has been indicted for. It's less about U.S. national security. It's more about an ugly, salacious affair with a porn star. And in that regard, how much are people going to care? Also, I should mention in the coming weeks, you're going to have a case against Hunter Biden, and those that support Trump will be promoting that and to an enormous degree, irrespective of whether he's found guilty or innocent. And I think for most comparatively low information voters in the United States, their ability to make heads or tails of who's telling the truth and what they should think coming out of these two cases is going to be limited.
Ian, we have to leave it there. Before we go, I will congratulate you. You gave a commencement address at Columbia, and not a single student got up and walked out. You performed some magic there. Thanks for coming on the show
thanks,
as well.
Man. Appreciate it.
It looks like interest rates aren't heading down anytime soon, but that's not necessarily bad news for investors. The outlook for Fed's next move and where to put your money after this. Many had high hopes for lower interest rates in 2024, but sticky inflation is keeping rate cuts off the table. However, investors may have less to worry about than you'd think. It's the Barron's cover story this week, written by Barron's senior writer, Nicholas Jasinski, and he joins the panel now. Nick, a great story. Explain to us, how did we get from 6 interest rates in 2024 to now maybe 1, according to market predictions, and you say none?
I don't think the Fed is going to cut this year. The data just does not support it. Jack, if I were to put you into a dark room and just read you the economic numbers and the inflation numbers, you would be surprised that we're even talking about rate cuts. Economic growth is strong. The labor market is tight. Consumers are spending money. Fiscal policy is incredibly stimulative. The deficit this year is something like 6% of GDP. That's a huge boost to the economy, and that's not going anywhere in an election year or beyond, for that matter. And the result is, while inflation fell a good amount last year, it's been stuck moving sideways well above the Fed's 2% target so far this year.
Yeah, we went from 9 to 3 at a pretty good pace, and then we just seem stuck now. What's between 3 and 2?
Services inflation continues to be the problem. There's just not enough workers in a lot of labor-intensive industries, and that means wages are rising and those prices are being passed along to consumers. Housing is another part of the services section of inflation, and that's also been pretty sticky.
Yeah, I mean, those housing prices are not coming down anytime soon. Inventory is just too tight. And even if things do ease up a little bit, it's not going to help the rental market anytime soon because, leases typically run on a 12-month period, so every month just 1/12 of the inventory comes up for renewal, so it takes time for those trends to play out.
Yeah, it's a slow process of getting that out of the inflation numbers. The other problem this year is that goods inflation is back. Last year, you had a real unwinding of a lot of the supply chain issues we had during the pandemic. But so far this year, there's issues with the Suez Canal, with the Panama Canal because of the drought there. Commodity inflation is back. Energy prices are up. Copper is going crazy. Those are raw material inputs into a lot of goods. So goods inflation has come back in 2024 so far. And the Fed is just not going to get the confidence they need that inflation is going back down to 2% anytime soon.
So, Nick, the stock market has dealt with the fact that we expected 6 cuts. Now we expect 1. The market's been okay. Is it going to be able to handle no cuts this year?
Absolutely. I think you're right. It's surprising that the market is up as much as it is. If I told you at the beginning of the year that we're not going to get any rate cuts, I don't think you'd tell me that the market is going to be up by double digits. But the result is, it's because the economy is strong. That's why the Fed is not cutting. And that's good for earnings. That's good for the market. it can continue to grow even without rate cuts, and you still have this kicker of the AI trade, which doesn't matter what's going on in the economy or what the Fed is doing. People are still going to pile into those AI stocks because of the long-term opportunity there.
But Nick, the economy does matter. Why is it not getting hurt as much as you would think, with rates really quickly going from 0 to 5%?
That's a really good question, and I think that's something that economists are going to be taking a look at for a long time. There are all kinds of reasons to believe that the economy today just is not as sensitive to changes in interest rates as it used to be. Part of that is the legacy of the 15 years before the Fed started raising interest rates, where we had these ultra-low rates, consumers locked in their 30-year mortgages at low rates, corporations refinanced and extended their maturities. So you still have that legacy of this low rate debt that's out there in the economy. And then you just have these secular changes where the economy, businesses are more concentrated in software and digital services. It's less capital intensive. And the recipe is that you need higher for longer interest rates for that to flow through into the real economy.
If you're not building factories anymore, you don't need to borrow as much.
That's exactly right.
Yeah, and I mean, no complaints here. I don't have to borrow anytime soon. I'm still getting 4.25 in my online-only savings account. And meanwhile, my mortgage is 3.4. So
that's a good trade.
it is indeed. Yeah.
So, Nick, you say that there are going to be no cuts. You say the economy is going to be strong. Where could you be wrong?
I think a key variable is the labor market. When you look at, you really got to squint today to see weakness in the labor market, but that could pick up a little bit. And I think that's something that the Fed is going to be very sensitive to. They have a dual mandate to keep price stability and maximum employment, and I think they're pretty sensitive to any signs of unemployment starting to pick up.
Well, the original goal of the Fed, right, was to try to cool down that labor market a little bit. We got numbers coming out in a week on the jobs market. What will you be looking for to see if there is that turnover in labor and suddenly we'll be okay on inflation?
So I look at some of the subsets like cyclical sectors and what hiring is doing there. Those are things that are more sensitive to the economy. That excludes healthcare, government. You can also look at things like temporary service jobs, temp workers. Those have actually outright declined so far this year.
And that's often a leading indicator.
Those are leading indicators.
Thanks a lot, Nick. Appreciate it.
Thank you.
Ben and Jacob have a pair of investment ideas, and Elizabeth is diving into the new rules of real estate taking effect this summer. Stay right there. Elizabeth, new rules on real estate commissions go into effect this summer as a result of a lawsuit that challenged the whole process, said fees were too high. Court agreed. So what will home buyers and sellers encounter in August when this thing goes into effect?
Yeah, there's still a lot of moving parts, and we'll have to see how it all plays out. So typically what happens now is when you sell your house, you pay both the seller's agent, your own agent, and the buyer's agent a commission out of the proceeds of the sale. It's typically 6%, split both ways. Now, that will likely come down a little bit. We don't know, it might vary from transaction to transaction. But bottom line, negotiation is going to be all the more important in this new environment. Both parties are going to have to come to the table in a way that they didn't before.
It's going to be tricky for the pioneers who have to figure this out in the beginning. But I'm also hearing about more of a fee-based approach. How's that going to work?
Exactly. There's some more and more brokers who are working on a flat fee or even on an a la carte basis, so you can choose the services you want and go from there. But it's going to be important, especially for buyers in this new environment, to sign what's called a buyer broker agreement even before they start looking for houses. So the process is going to be a little more formalized.
I think the net result is fees are going to come down a little bit, probably a good thing for buyers.
Exactly.
All righty. Let's go to actionable ideas. Ben, you've got one of my favorite charts on Wall Street. What's your pick?
My pick is Corning. This was an internet favorite during the dot-com era, and it has never really gone back to those levels. But right now, it got upgraded by J.P. Morgan. They see it as being both a cyclical and a secular beneficiary right now. Cyclical from consumers wanting more products that use Corning's products, which are glass kind of things, but also from the benefits of AI. The stock has done pretty well recently. It's hitting, it just broke through some support levels. It looks like an interesting time to take a look.
It was fiber that got everybody excited back in those days, but they make the glass on iPhones and a lot of good stuff. What do you have for us, Jacob?
Airbnb, it's down about 8% since it released earnings early in May. Management talked about, this is a growing company, but management talked about decelerating growth going into the second quarter. You do have, as we were talking about earlier on the show, higher rates and people slowing down their spending on travel and stuff like that. So the market's really concerned. The thing is that the company usually guides really conservatively, and long term, you're having alternative accommodations taking share from hotels. That's going to be there for a long time. The growth is going to be really high, and you want to get it at this price.
And let's face it, the reason we have services inflation is because people want to travel, right, and go to restaurants, et cetera.
Indeed.
All righty, thanks, guys. Jacob, Ben, Elizabeth, great ideas as always. Thank you. To read more, check out this week's edition of Barron's.com. And that's all for us. We'll see you next week on Barron's Roundtable.